Lesson 4, Trading Indicators. Before we get started, I'd like to ask you to read what you see here in front of you. I would also like to point out that as we go through this lesson, in the center of your page, you'll see a number at the center bottom. That is the number of slide we are working on. If by chance in your workbook you get lost or behind or lose your place, just look at the slide number at the bottom center of your page and then find it in your book, and you'll be up with the lesson. Another thing I'd like to point out is I have created a sign that says important information. That sign is for a perhaps trader's tip or very critical and or important information that can help you learn to trade. These are things that you may want to memorize and make it a part of your trading style and technique. There are 16 lessons that teach people how to trade that can help you trade not only on the Forex but focus in on technical analysis. Technical analysis is the study of chart reading. When you learn technical analysis, it is applicable to all charts, whether you're trading stocks, commodities, currencies, whatever it may be. That education can be quite helpful. Several years ago, I heard this statement: successful traders will do what unsuccessful traders can't and won't do. This is probably one of the most profound statements I've ever heard. Change the name traders and turn it into people. Successful people will do what unsuccessful people can't and won't do. Successful people are successful for a reason. They have become successful because they have bought into an education on whatever it is they are doing, and have also bought into being disciplined in a niche business. Success comes from being disciplined. Successful traders are disciplined individuals. Successful traders have taken the time to educate themselves about the market. They understand how the market works. They understand how they need to work as an individual trading in the market, and therefore they have acquired a set of disciplines that allow them to become successful in the market. Successful traders will do what unsuccessful traders can't and won't do. Several years ago, I became apprised of this 21-day 3% rule. The human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it will continue the loss of information until it settles at retaining only 3% of the original acquired information. That means that after you listen to this lesson, within 3 days you will have forgot 80% of the information that has been given to you from this lesson. Taking that into consideration, I admonish you to listen to this lesson over and over again until you extract the important information that can help you become a better trader. When it comes time to open up your margin account and start trading, our focus as a company is to help you place yourself in a position to have 80 to 90% recall of the information you have been taught, and place you on the side of hopefully becoming successful as you trade. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. You will be introduced to the technical side of dealing with an indicator. You will learn to use these indicators with your other knowledge. You will learn to find a trade with an indicator and only trade it with equity management. You will learn to create a trading plan, trade that plan, and financially protect yourself in every trade. Before we get started, let's review reading a trading chart and placing orders. We focus in on using Japanese candlesticks. You can use bar charts. You also can use line charts. Japanese candlesticks are very user-friendly. They monitor an open, a high, a low, and a close of a time period. Japanese candlesticks can be 1 minute candlesticks, 5 minutes, 1 hour, 2 hours, 4 hours, daily, weekly. There are bullish candles and there are bearish candles. In a bullish candle, the close is higher than the open and are usually hollow in color, to where a bearish candle, which signifies the market is going down, its close is lower than its open. All the charts we look at are bid charts, and charts are monitoring a bid and an ask price. As the market is moving, you can either choose a bid chart or an ask chart, but the majority of traders use bid charts. All charts are bid charts and display the bid price and the bid movement. There is that spread between bid and ask. An ask chart, depending on the spread, would look identical to the bid chart, other than it would be anywhere from 3 to 10 pips higher than the bid price. As the market moves, the market is monitoring price movement, with the bid being recorded in front of you and the ask price being recorded approximately 3 to 10 pips higher. As you place orders on the Forex or in the market, just remember, we buy on the ask and we sell on the bid, which means when it's time for you to place an order, if you are buying, you will enter the market buying on the ask, and you will place your protective stop loss orders at the last low if you are buying, and that protective stop loss order, in this case, since you're buying, you would have a sell stop, which is on the bid. You would also have a sell limit, which is on the bid, for profit. If you are selling, entering the market, shorting the market, your protective loss stop would be on the ask because it would be a buy stop, and your protective or your limit, buy limit, will be on the ask for profit. Keep that in mind as you trade. Remember that as the market moves and as prices are being recorded, the market is monitoring the bid price, which means the ask price is just a few pips higher, 3 to 10 pips higher, which means if the market comes close to your buy stop order, the ask will hit it before the bid, which means if you have a price at which you have placed a stop order at and the bid price does not hit it, chances are the ask price might have hit it, but it's just not recorded because this is a bid price chart. Types of orders. We have taught you in lesson 1 the market order, the limit order, and the stop order. Remember, market orders are at the market, limit orders are at a specified price, and you will be filled at that order or better, and a stop order is at a specified price that turns into a market order when hit. Keep in mind, if that is where the market is, any order that is placed above the market would be an unfilled working order, an open order, and that order, if you are buying above the market, would be called a stop order. If you are selling above the market, it's called a limit order. If you were to place an order anywhere below wherever the market is, that order would be an open order, a working order, an unfilled order, but it would also be called, if you are buying below the market, it's called a limit order. If you are selling below the market, it's called a stop order. Those are the rules of trading. It's something you will have to memorize. Don't worry about it. It becomes very easy to understand as you start to practice and trade. Ordering rules. Every time you enter, you should have 2 exits. When you buy and your position is bullish and long, you should have 2 sells, one for profit and one for loss. Do not trade without a quantified stop order. Conversely, or if we look at this chart, let's just say the market breaks this trend line, it enters into the buy zone, which is lesson 6. You end up buying, you need to place an order at your last low, and this limit order for profit will be a sell limit order, just like this will be a sell stop order. Ordering exit or ordering rules, every entry should have 2 exits. Every time you sell, as a bear, having a position that is short, you should have two buy orders. Every sell has two buys, one for loss and one for profit. Let's look at this chart. If you short the market here, you should have a stop order for loss and a limit order for profit. An OCO, which is whenever you enter the market, you should have a sell order for profit, a sell order for loss. On a buy, it would be the opposite on a sell. But an OCO means if we enter here on a buy, if the market rallies and hits the limit order, it'll automatically cancel the stop order. If it hits the stop order first, it'll automatically cancel the limit order for profit. Therefore, you don't have to sit around and watch the charts. You can just set it and forget it. Cancel, replace. Please go to Lesson 16, which focuses in on canceling and replacing, as well as Lesson 3, Equity Management. But to properly cancel and replace, remember, do not cancel and replace if you are chasing the market until the market has established a new high. Cancel and replacing is a very profitable way to chase the market and lock in profit along the way. As you cancel and replace shorting the market, only cancel and replace to the last high after the market has made a new low. If we were to sell the market here with a stop order there as the market makes a new low, we then can cancel or replace our stop from the last high to the new high. As it makes a new low, we can move it from that high to this high. As it establishes a new low, bounces, retraces, and then U-turns and makes a new low, we can now go from that high to this high, from this high to this high, from this high to this high, from this high to this high, locking in profit as we go. Very effective way. Remember, bulls buy low first and then sell high later. That's what a bull does. They enter the market buying first and selling second. The objective in making a profit is to buy low and sell high. Buy low, sell high. Buy low, sell high. Indicators can play a big part in that success. Remember, if you're shorting the market, you will sell high first and buy low, which is the opposite of buying low and selling high. Learning to short the market is taught in Lesson 1. If you have any questions about it, feel free to call our company or read the end of this lesson in your work manual. It'll explain to you in detail what shorting the market is about. Be that as it may, bears want the market to fall. They want the market to dip, go down, have a reaction. As the market dips or falls, traders that short the market sell first and buy second. They can use indicators that can help them sell high and buy low, which is buying low and selling high. Technical traders learn to read charts. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives a trader a high probability of knowing where the market is going. That's what these lessons are all about. A chart is a chart is a chart. Technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you've been educated on how to read